Yes, well, good morning, everyone. Welcome back to the class Investment and Portfolio Management. This week is the week number 9, right? That we will discuss on the topic of the investing in fixed income security. There are two subtopics of this chapter. The first subtopic is the 9.1, the basic concept of the fixed income security. And here you are, the second subtopic that is the bond valuation. These topics is not necessarily when you make an investment decision, investing in the bond, including any mutual funds with their investment policy, are investing in the fixed income security. So here in terms of the PowerPoint set of the 9.2, the bond valuation here. This is the learning objective that I expect you have the idea after we complete the PowerPoint set of the 9.2 bond valuation. The first learning objective that is here. I expect the students to understand the advantages of the bond valuations. And the second learning objective is that I expect you can determine the price of the bond. And as well as the third learning objective here, that I expect you can determine the yield, right? The yield of the bond. And the last one, the last learning objective here that I expect you can explain the relationship between change in the interest rate and the bond price. So here, because of the learning objective, bring us to this content. The first one should be the advantages of the bond valuation. The second one should be the bond valuation. Third one should be the applying bond valuation. Fourth one, number four is the bond price. Number 5 is bond yield. And the last one is the relationship between interest rate and bond price. So shall we start with the first one, the advantages of the bond valuations. So here on this slide, right, on this slide, I show you the concept of the advantages of the bond valuation. Firstly, right, investment decision. Here as the first bullet point, the investment decisions, the bond valuation will help you are the investor, right? The bond valuation will help investor determine whether a bond is fairly priced, overvalued, or undervalued. Secondly, the advantages of the bond valuation is the predictable return. What does it mean? The bond valuations will provide the expected cash flow and total return before making an investment, right? Before making an investment. And then the third one, yield comparison. The third advantage is the yield comparisons. The bond valuations will allow the investor to compare yield, right, across the different bonds and or other asset class before do the decisions making, invest in any kind of the asset class. The fourth advantage of the bond valuation is that the bond valuation will help investor evaluate the interest rate risk, right? That we call the risk assessment, right? Risk assessment. That is the bond valuation will help the investor evaluate interest rate risk, credit risk, and reinvestment risk, right here. And the last advantage of the bond valuation is the portfolio management. Bond valuation will help investor, right? Will help you in constructing and balancing a bond, right, portfolio based on the return objective and the risk tolerance. So here in terms of the bond valuation, what is bond valuation? The bond valuation here is a technique to determine the fair price. I mean the fair value or the intrinsic value of that bond, right? By calculating the present value of the future cash flow, including coupon payment and the principal at the end of the period that you will get the principal at the end of the period. I mean at the maturity date of the bond, right? So here applying the bond valuation, what it is, right? How to apply the bond valuation. I can give you, right? I provide you as the step by step. Step one, how to, right? How to apply the concept of the bond valuations in the real world. Firstly, at the step one, first step, you need to calculate the intrinsic value or the fair price of the bond. Second, right, the step two, you compare that intrinsic value that you calculated with market price, right? With market price. Then you compare the intrinsic value with the market price. You can make investment decisions. If, right, if the price is like a greater or if the price is less, so you can have the idea, should you invest or not invest in that bond. So let's see here, applying bond valuation. So how to do the decisions making, whether invest or not invest in that bond, how to apply it. Okay, here based on the previous slide, right? Based on the previous slide at the step one, step two, and the step three, right? After you calculate the valuation of that bond, you then get the intrinsic value or the fair value, the fair price of that bond, right? Okay, after that, you compare the intrinsic value of that bond with the market price, I mean the current price at the time, right, of that bond that is traded in the secondary markets. If you expect to invest in bond A, for example, please imagine that, okay, you tentatively invest in the bond A. If you expect to invest in the bond A, you calculated, right? You already calculated the intrinsic value of bond A. You get the number, right? So if the intrinsic value of bond A, here on the first one, if the intrinsic value or the fair price of the bond is greater than the market value or the market price of that bond on that period, then you can have, right, you can decide that you should buy that bond. Again, I say again that if you expect to invest the bond A, right, if you expect to invest bond A, you calculate the intrinsic value of bond A. You already get the number, right? The value of the bond A. Then you compare the intrinsic value of bond A here with the market value. If you compare the intrinsic value of bond A, the bond A, right, provide you the greater value than the market value of the bond A at that time, then you should buy the bond A, right? Then you should buy the bond A. So on the other hand, so in the second case, right? In the second case, on the other hand, if you already have the bond B, okay, in this case, for this example, I focus on the bond B, right? Bond B. So in this case, you already have the bond B, right? Bond B. So if you calculate, the intrinsic value of the bond B, then you compare that value or the fair value with the market price. You can notice that the intrinsic value of bond B is less than the market value in this case. So if you have that bond, so what does it mean? It means that you should sell, right? You should sell the bond in the market, or if you didn't have the bond at that time, you should not, right? You should not buy that bond, right? You should not buy that bond. So this is how to apply the basic concept, the concept of the bond valuation in investing in the bond, right? In the bond. So in terms of the bond, right? You need to have the idea. I would love to introduce you to have the concept or the idea of the bond price, right? Of the bond price. So here I show you, I provide you, I share you. There are three, right? There are three aspects of the bond price. First one, par bond, right? Par bond, the bond price. Second one is the premium bond. The third one or the last one is the discount bond. What is a par bond? What is the premium bond? What is the discount bond? Let's see. Here I will introduce you firstly, right? The first one should be the par bond, what it is, right? What is the par bond? You buy a bond, for example, please follow me here that please imagine that you buy a bond at par, right? At par as the face value, at par at 1,000 Thai baht, right? As the face value. We call par bond. The yield of the par bond will be equal, right? Please notice here. The yield of the par bond will be equal to its coupon payment. I mean the coupon rate. Let's see here, this diagram, this timeline. So please consider that here. For example, you invest in the 3 years, right? CPO corporate bond that offer you 7%, right? That offer you the yield at 7%. Okay, I say again that, for example, on this slide, for example, you invest a 3-year CPO corporate bond that offer you the yield at 7%. When you calculate the intrinsic value of this bond that pay you the yield 7%, basically the yield of the CPO is equal the coupon payment of this bond. So what does it mean, right? It means that equal, right? The yield of this bond equal, right? Equal the coupon payment of this bond. So then if, right, if the price of this bond is greater than 1,000 Thai baht, should you invest in this bond? The answer is no, right? You should not, right? You should not invest, right? Since, right, because you should invest, you should buy this bond at the par, at the price at the par, that is the 1,000 Thai baht. So if you can buy this bond less than 1,000 Thai baht, what does it mean? It means you tentatively get the yield return greater than 7%, right? On the other hand, if you buy this bond with greater than 1,000 Thai baht, in this case, you buy the bond, right? The CPO 3 years with the money that greater than 1,000 Thai baht. What does it mean? It means that you earn the return less than 7%. So here, if you buy the bond, right, at 1,000 Thai baht, it means that you buy this bond at par. We call here par bond, right? Please notice here that at the beginning of the period, right, here at the beginning of the period, you need to pay, right? At the beginning of the period, you need to pay minus, right, 1,000 Thai baht. That is the cash outflow at the beginning of the year 0. During the year, right, at the end of year 1, at the end of year 2, at the end of year 3, right, you will get the coupon payment at 70 baht. That is 7%, right, of the 1,000 baht. So at the end of the year 3, right, at the maturity there, you will get the principal at the end of the maturity date. So please notice here that at the beginning of the period, you pay minus 1,000 Thai baht, right? At the end of the period, you get 1,000 Thai baht as well. We call here as the par bond. So here, what is the premium bond, right? Premium bond, what is the premium bond? The premium bond, right? In this case, please imagine that if you buy a bond greater than 1,000 Thai baht, we call premium bond. The yield, right? The yield that you get from buying the premium bond will less than the coupon payment that specify on the bond, right, since launch. So here in this case, please notice this timeline, right? This timeline. In the case of the premium bond, you invest a 3-year Bangchak, right? BCP, Bangchak Public Company Limited, the BCP corporate bond at the yield 5%. Here at the yield 5%, with less than the coupon payment of the BCP 7%. That is the 7% is the coupon since launched, right? Since issue. in order to get the coupon payment 7%, as specified on the face of the BCP bond, you need to pay more than 1,000 Thai baht, right? So again, I repeat again that this coupon, the coupon payment of the BCP corporate bond is 7%. But at the time, right, at the time you want to invest, you want to buy this BCP bond, right? But at the time, the market price, right? The market yield, the yield return at the time is 5%. So if you want to get this BCP corporate bond in order to get the coupon payment 7%, right? Every year, you need to pay, right? You need to pay the price of the bond at the beginning of the period greater than 1,000 Thai baht, right? So here you can, right? You can calculate the price of the bond by this formula. You can apply a formula to calculate the fair price or the intrinsic value of a bond. On this slide, I show you the formula how to calculate the bond, price. You can apply this formula to calculate both of the premium bond and the discount bond. So, okay, here, please follow me that PMT. What does it mean? What is the PMT? PMT, please follow here. That's PMT is the coupon payment that you should get from this bond during the holding period. So, and then here I, right, from this formula, I, what it is, the I is the yield, right, that you get from investing this bond when you buy this bond in the secondary market. So in year one, please focus here in year one, you give the power 1, right? In year 3, you give the power 3 to compute or to calculate the present value of each cash flow in the future. So what does this mean? You need to, right? You need to calculate the present value of this cash flow. The cash flow number 1, the cash flow number 2, and the cash flow number 3. The cash flow number 3, there are 2 cash flow number 3 because the cash flow number 3 here is the interest payment, and the cash flow number 3 here is the principal, right? Is the principal. Then you need to calculate the present value of the cash flow 1, 2, 3, and 3. Get back into the present value. You then get the price of the bond. So I calculate for you guys that should be, right, 1,054, right, and 1,054 baht. So please notice here that 1,054 baht is greater than 1,000, right? So here we call this kind of bond as the premium bond. So you have the idea how to calculate the bond price by formula. But as well, I give you, right? I give you the tool as well. You can calculate, right? You can calculate the bond price by the financial calculator here. So in terms of the financial calculator, I will give you, right? I will give you the explanation on here. So in terms of the premium bond calculation by financial calculator, how to do it, right? How to do it? You key in the value of each field. You then get the same number of the when you using the formula. So here you put the future value, right? The future value is the money that you will get at the end of the period. That should be 1,000, right? So the period should be the 3 years, the annual return, right? The annual return, that is the yield that you get, right, from this investment, that is the 5%. The payment, PMT, right, is the coupon payment that every end of each year, the issuer will give you, right? They will give you the interest, will give you the coupon. Then you put here payment, PMT is 70, future value 1,000, annual rate is 5%. 5% is the yield, right? Is the yield of is the market yield. Period is the 3 because of the 3 year. Then you, right? Then you click here, you click PV. You click PV. The financial calculator will give you the present value of this bond. That should be 1,054, right? And 54 baht. That is the same number when you do the calculations by the formula. Here, in terms of the discount bond, right? In terms of the discount bond, what is the discount bond? If you buy a bond, right? If you buy a bond less than 1,000 Thai baht, right? Less than 1,000 Thai baht, that is mean that less than the par value, right? We call discount bond. The yield that you get from buying the discount bond, right, will greater than the coupon, right? The coupon that specified on the bond since runs. So let's see here the timeline, right? The timeline of the discount bond. So here, this is the cash flow, right? This is the cash flow of the discount bond. You consider, right? Right now, you consider a 3-year corporate bond of the AIS Advanced Info, right? With the coupon 7%. But at the time, you want to buy this bond, but the yield, right? The yield of the bond at the time is the 9%. You should, right? You then should pay the money at the beginning of the period less than 1,000. What does it mean? Please notice here that the coupon, right? The coupon on the face, right? The coupon payment of that bond since launch is the 7%. But the return, right? The yield at the time, the market yield is the 9%. What does it mean? The yield, right? The yield greater than the coupon. Then you pay the price, right? You invest the bond with the discount, right? With the discount, we call here is the discount bond. So in this case, right, you can calculate the bond price by the formula as well. You apply the same formula as I mentioned earlier in the previous slide, that you apply 70 baht, right? That is the PMT, the coupon payment. But in this case, please notice here that in this for the I, right, you apply 9%, right? So you put the number in order to calculate each cash flow. The cash flow number 1, you apply 70 baht as the PMT, the coupon payment, right? Then you apply 9% as the I, power 1 as the cash flow 1, power 2 as the cash flow 2, until the cash flow number n. So in this case, there are just 3 here. Then for the number 3, right, you apply the 70 coupon payment, right, with the 9% power 3 for the interest. And here for the last term, you apply 1,000 Thai baht as the principal, right? And you apply the I is the interest as 9% and power by 3. Then you calculate, you compute, you compute this cash flow, get back to the present value, you will get the bond price that is the 949 baht. Please notice here that the 949 baht is less than 1,000, right? So we call here is the discount bond. In this case, same, right? Same again that you can apply the financial calculator as well. In this case, you put the PMT, right? 70, right? 70. The future value should be 1,000, but in this case, the annual rate will change from 5% in the case of the premium bond. But here, in terms of the discount bond, you use the 9%. The period is the 3 years, right? Then you click PV. The financial calculator will give you the number of the bond price. That is the minus 449 baht. Here, we already done, right, in terms of the bond price, Here on this page, right, on this slide, I just give you the summarized of the bond price that should be the par bond, premium bond, and discount bond. So we already done in terms of the bond price. We move, right? We move to the bond yield. What it is, the bond yield. In terms of the bond yield, in the part of the bond yield or the return on investing in bond, I would love to introduce you to have the idea to know how to calculate the first one. coupon yield or the nominal yield. Second yield or second yield return should be the current yield. And then the third one should be YTM or the yield to maturity. And the last one is the yield to maturity. But in this case, the yield to maturity of the zero coupon debt. Okay, here, firstly, I want to introduce you to know the coupon yield or the nominal yield. So what is the nominal yield or the another word that is the coupon yield? Nominal yield is the interest rate that the bond issuer, the bond issuer promise to the investor, right? Promise to pay the investor. The nominal yield is fixed and applied to the life of the bond, right? It might be for 1 year, 3 years, 5 years, 10 years, right? Sometimes it's also referred to as the nominal rate or the coupon rate or the coupon yield. So how to calculate, how to compute the coupon yield or the nominal yield, right? The calculation. So you apply, right, the annual coupon. So it means that for the whole year, the coupon you get from the investment divided by par value. What is the par value? Par value should be 1,000, right? So in this case, right, for this example on this slide, you can apply the formula to calculate the nominal yield investing in bond A. You apply coupon, right? You apply annual coupon 80, right? 80 divided by par value, that is 1,000. You then get the nominal yield at 8%. Here you are, how to calculate the nominal yield, right? The nominal yield. So the second type, right? The second type of the yield that I want to introduce you that we call the current yield. What is the current yield, right? The current yield evaluate the current price of the bond rather than looking for the return from the face value at 1,000 Thai baht, right? So how to calculate the current price? You need to apply the annual here. You need to apply the annual coupon, right? On this slide, you need to apply the annual coupon divided by bond price. Please notice here that in terms of the current price, you need to apply bond price, right? Again, I say again that in order to calculate or in order to compute the current yield, you need to use the bond price, not the par, right? Not the par. So in this case, in order to calculate the current yield, you use the annual coupon divided by the bond price. So in this case, right? In this case, from this slide, you apply the annual coupon, right? You receive from that bond 32.5, right? 32.5 divided by the bond price at the time, 980 baht, right? Then you will get the current yield of this bond at 3.31%. Here, we already complete the current yield. Move to, right, then the yield to maturity. What is the yield maturity? Okay, firstly, as I mentioned that in the previous slide, we look at the current yield, that the current yield measure the return of the bond, only cash flow as coupon. Again, I say again that in terms of the current yield, right? Current yield make sure the return of a bond only the cash inflow, right? The cash inflow. But the yield to maturity, right? The yield to maturity make sure the return of a bond, both of cash inflow, right? Both of cash inflow as coupon and the price of the bond over the life of that bond, right? The bond price probably increase or decrease over the life of the bond, right? In summary, right, the yield to maturity is the standard measure the total rate of return. Then how to calculate the total, right? The total return at the yield to maturity, you need to use the bond price, right? At the beginning of the period, it might be decreased or decreased. You add up the bond price with the cash flow, that is the coupon. Then you will get the yield to maturity. So here in terms of the yield to maturity, I provide you the two examples. The example one of the YTM, the yield to maturity is the bond A in the case of the discount bond. And in the bond B, in the case of the premium bond, please notice here that the bond A, discount bond, at the beginning of the period, you pay 950,050 baht, right? Less than 1,000. That is the par of the bond. At the end of the period, right, you get 1,000 get back. On the opposite side, here the bond B that we treat as the premium bond. Why premium bond? Because at the beginning of the period, you pay, right, the money, right, negative or the minus 10,000 with 50 baht. And at the end of the period, the year 3, you get 1,000 Thai baht get back. How to calculate the yield to maturity of bond A as the discount bond here. So again, you simply like put the payment here, the payment here. That is the discount bond, right? You put the present value, right, of the bond, that is the minus 5, that is the 950 baht. The payment is the 70. Future value, exactly the future value, always 1,000, right? Always 1,000. The period is the 3. Then you click the rate, right? You click the rate. The financial calculator will give you the yield to maturity of this discount bond, that is the 8.97%. Here, in this case of the premium bond, right? In the case of the premium bond, same, right? The cash flow is the same at the payment, the coupon payment at the 70 baht, right? At the end of the period. Future value should be, right? Future value always be 1,000, right? 1,000. Period is the 3 years, same as the same scenario. But in this case, the premium bond, you put the present value that minus 1,050 baht, right? Then you click the rate. The financial calculator will give you the yield to maturity of this premium bond, that is 5.15%. Here, I already write complete in terms of the yield to maturity. And here, for the yield to maturity on a zero coupon debt, what does this mean? It means that you have the idea, right? The zero coupon debt is mean that during the period, it means that it doesn't matter for the 1 year, 2, 3 years, or the 5 year. During the period, during the holding period, the investor get nothing. I mean that bond, the zero coupon bond, will not pay any coupon during the holding period, right? So in this case, yield to maturity on the zero coupon, I show you the cash flow here. At the beginning of the period, right? So in this case, right, there is the 3 years zero coupon debt. In this case, 3-year zero coupon debt. At the beginning of the year, right? At the beginning of the period, you pay 890 baht. 890 baht, right? Thai baht. At the end of year 1, nothing. At the end of year 2, nothing. At the end of year 3, nothing as well, because that is the zero coupon debt. It means that during the holding period, right? This zero coupon debt will not pay any coupon. And then you will get the par value at the end of the period. In this case is the 1,000 Thai baht, 1,000 Thai baht. You can calculate, right? You can calculate the yield to maturity of this zero coupon debt as well here. By here, right, you apply the present value 890 baht, right? Future value should be always 1,000, right? 1,000 Thai baht. The period is the 3. Payment 0, because this is the zero coupon debt. During the period for 3 years, you get nothing from this investment, but you will get 1,000 baht at the end of the period, right? You put 1,000 baht in the future value. You then click rate, right? You click rate. The financial calculator will give you the number of the yield to maturity of this zero coupon debt that is 3.96%. Here we come to the might be the last part of the topics like a 9.2, right? The 9.2, that is the bond valuation. I would love to introduce you again. I want to repeat you again that the relationship between interest rate, right? The interest rate and the bond price, what it is. Okay, here get back to the bond price. As I mentioned earlier, it might be in the PowerPoint set of the 9.1 as well. The relationship between interest rate and bond price should be inverse, right? Inverse relationship. So when the interest rate increase, the bond price will be decreased, right? You then buy a discount bond. But like on the opposite side, when the interest rate decrease, right? When the interest rate decrease, the bond price will be increased, right? You then buy the bond like the premium bond. So here, that's all. I would love to introduce you to have the idea in terms of the topics of the bond valuations.